I'd like to call the Finance, Audit, and Budget Committee for Tuesday, April 12th, 2022 to order. First item is Pledge of Allegiance.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right, next item is adoption of the agenda. Need a motion
Romano
to
adopts
adopt.
the agenda.
Van Sickle support.
Moved by Romano, supported by Van Sickle. Any discussion? Seeing none, please vote.
Motion passes 13-0.
Okay, next item is approval of minutes dated March 15th, 2022. Need a motion to approve.
Support Song.
Made by Wallace, supported by Song. Any corrections to the minutes? Seeing or hearing none, please vote.
Motion passes 13-0.
Okay, next item is public participation. This is the first opportunity for public participation for those who would like to speak for a maximum of 3 minutes on any item which is on today's agenda. There'll also be a second opportunity for public participation for those who would like to speak on any issue. Anyone from the public like to speak? If you would, please come to the podium. Going once, going twice. We'll close public participation. We'll move on to presentations. The first one for 6A is Retiree Healthcare Funds Update. I need a motion to receive and file.
Motion to receive and file, Van Sickle.
Support by Nard.
Made by Van Sickle, supported by Nard. And we have Louise Gates here to present. You have the floor, Louise.
Thank you so much. Good afternoon, everyone. My name is Louise Gates. I am the actuary for the Retiree Health Plan. Does everyone have a copy of the December 31st, 2019 actuarial report? You do. Excellent. The county provides retiree health benefits to eligible county employees, current and former. And those benefit obligations have a price tag. We call those the liabilities. So the value in today's dollars of the benefit promise. And that's shown in your report on page A-2, line item 5. So as of the date that we did our calculations, the value of those obligations is over $489 million. So nearly $500 million, or stated differently, about $500 million in obligations. The assets that you have available in trust to provide for those obligations is over $300 million. So in terms of looking at the financial strength of the program, which is how most people think of assets, your obligations are currently 69% funded. So for every dollar of liability, you have 69 cents in assets, which is really a very good result when you consider that the county issued bonds to fund these obligations back in, I believe, 2015. So you've made tremendous progress really over about a 6-year period in financing these obligations and creating, greater security for the members of the plan. And when I compare where you are today with the projections that we did back in 2013, based on the projections that we did back then, and this would have been before you issued the bonds, you started out in 2013 being about 36% funded. So that was before the county made a commitment to advance fund these benefits in an orderly manner. So at that point in time, you were about 36% funded. So for every dollar of obligation, the county had 36 cents in assets to pay for those obligations. And the projections, we expected you to be about 52% funded today. But in fact, you're about 69% funded on the same basis. And that really puts you in a stronger position than many retiree health plans that we see here in the state of Michigan, and when we look at public plans across the country. And when you consider the assets that you also have held in the bond trust, the funding percent is even higher. And Steve will talk more about that in his presentation. But this is excellent news, and I'm here today as the bearer of good news, and I'm happy to answer any questions that anyone may have regarding the retiree health plan.
Thank you, Louise. I know myself and Commissioner Hall both sit on this committee, and we get this report. This was actually 19 data, I believe, too.
2019.
So maybe you want to enlighten us on that there's actually more good news coming because this is only 2019 data.
Right. So as the Commissioner is pointing out, calendar year 2020 and 2021 were very good years for investors. And the retiree health plan is an investor. You have assets held in trust. Those are professionally managed. They generate investment income. The contributions and the investment income that they generate is how you're going to pay for these benefits. And as Joe is pointing out, those years were very good years, so the investment income that was generated is expected to be higher than actuarial expectations. So assuming a continuation of the excellent job that the county is doing in managing medical and prescription drug costs, assuming that that continues, and that's probably a good assumption, coupled with favorable investment income, we would expect to see an improvement in your funding percent above and beyond 69%. So really very good news all around.
Great. Commissioner Farrington.
Thank you, Chair. And thank you for coming and presenting this. It is good information. I guess my question is, we've had a 10 or 12-year run of good investments throughout the country. And my gut or whatever says that we're coming to the peak of that. So I'm a little surprised you say that we should be expecting better than 69%. Mm-hmm. Maybe not at the end of 21, but at the end of 22.
Yeah, well, right. Right.
Because it seems like that road's coming to an end, whether it is or isn't. The probability historically is that it's coming to an end.
Right.
So.
Nothing good lasts forever.
Yeah.
Exactly. Certainly the fund will have good years and bad years when it comes to experience. So assuming that, the markets don't plummet in a big way, we would expect some growth above 69% over the next 2 years. But the other element of all of this, it's not just the investment performance, it's also how your claims experience performs relative to expectations. That's actually a fairly big driver, equally important to the investment program. And the county has done a great job of managing prescription drug and medical benefit costs. And you've had a good run there as well. And to your point, that could change. We do have provisions in the valuation to account for some adverse experience. So we have sort of a reserve built in for adverse experience. And that reserve will help buffer the impact of adverse medical and prescription drug claims, with an end result being of stabilizing liabilities and contributions to the fund.
One final question. What actuarial target do you use for your estimates? 7% as a return?
Oh, the investment return? Currently, we're assuming, and it's a long-term expectation, that the fund earns 7% net of expenses.
All right. Thank you very much. Thank you, Chairman.
Commissioner Kleinfeld.
Thank you. I was just going to touch on your last question. The concept that even with bad years, the overall, over the period of it, if we hit a certain percent, we're going to be okay. I will tell you, and there's only a couple of us up here that were here when we voted on this, it was very scary, the concept of doing this, because if it didn't go right, it went really bad. And I remember, I believe you were here, Commissioner Sabatini, because we were openly discussing, okay, if this doesn't go right, we could be talking about bankruptcy. I do think it's one of the best decisions this county has ever made. And I think Steve's the one that brought it forward to us. One of the best decisions we ever made. And I wish that some of our local units of government had done the same thing. I know some of the ones that I know of are struggling, and I wish they would have done that. But first of all, congratulations to the staff of the county executive for having the guts, in my opinion, to bring this forward and ask us to take the leap. Thank you.
Commissioner Hall.
Thank you, Chair. You had said that this was very good news, and and I've seen this presentation before, when we originally had seen it, I think our financial advisor had indicated we were in the 1 percentile across the country for this type of funding. And as it applies to the end run of financial successes taking place in the stock market, we reevaluate the entire portfolio every 4 months and have just made major changes in addition to getting out of Russia to the portfolio to try and foresee the possible equity growth in the future in different asset class that our team looks at on a regular basis. So everybody knows, I think we went from 17% down to 11% in actual funding increases due to various investments that were made. At 11%, I'm sure most everybody in this room would take that in a heartbeat. So these kinds of decisions are what we take very, very seriously as a board. In this particular board, Joe mentioned we're both on it. This is the one that I chair, and we take great umbrance in looking at the investments. And I think totally, Steve can correct me, we're at 1.3 billion. You can't find too many counties in this country that can say that. So thanks again for presenting our audit report. That's all I have, Chair.
My pleasure.
Chair Brown.
Thank you. Thank you for coming. It's good information for the new members of the board to hear that our county is very solvent, and that's a credit to the previous boards and this current board for making decisions, and tough decisions at times. As Commissioner Kleinfeld alluded to, those are tough days, those decisions about what we were going to do. While we were watching City of Detroit go bankrupt, largely because of the same problem that they couldn't finance their obligations, this board stepped up and did the right thing to make sure that we take care of our obligations so they'll never have to be happen in this county. The taxpayers don't have to be on the hook for the bill, nor will the state. You raised an interesting question about the health care claims and prescription liability. We're always focused on the investment returns, as we should. But what has been our experience in the past, and how is it trending currently?
The county has done an excellent job of managing healthcare cost increases. And as you know, Commissioner, the largest part of those obligations are medical and prescription drug costs. You've have a lot of retirees, they're required to be in a Medicare Advantage plan, and the increase in those costs has been lower than what's been projected long-term. As the Commissioner pointed out, all good things will eventually come to an end. There's no guarantee that the favorable experience will continue. But right now, it's been good, and there's no indication in the short term that it will change. But we do have provisions built into the valuation to help mitigate the volatility associated with those claims.
But what have the claims experience been? Has it been a 5% increase year over year, or has it been 10? I remember hearing a presentation several years ago. We were talking double-digit claims, and we were bracing for what are we going to do?
Right.
But it hasn't been our experience, fortunately. But can you tell me just give me a sense of where those numbers are at?
Let's see. So it's always relative to what was anticipated. And the favorable experience has been largely in your post-65 population, those folks covered by Medicare Advantage. And so the expectation would be maybe that the costs would rise, like prospectively, maybe in the 6% range. And what we've seen in your plan, the per capita cost, because you're a self-insured plan, right? So the county is acting as it's like an insurance company. You're taking the risk associated with the claims, but you're also reaping the rewards. So the experience has been lower than 6%. In some years, it's actually decreased. It's been trending for your Medicare population negative. You know, it's been going down instead of going up.
I think part of this is probably due to the fact, in my opinion, but we offer good health care coverage to our employees. We offer a lot of preventative care within our coverages, which makes us unique from other counties. Oakland County, our big brother to the west, they don't offer the level of benefits to their employees that we do. And that's something we all should take pride in. Granted, our wages aren't as high as we'd like them to be to maintain and attract other employees, but our health care coverage is good, and I think that's reflected in our claims experience, don't you think? That's a direct correlation?
I think so. The pre-65 population, which we only get the claims for your retirees. The employee claims experience is, I don't think it's bundled into the work that we're doing for you. The claims experience there, I believe, has also been favorable, but the exceptional experience has been among your Medicare eligible population. And that's most of your retirees. That's more than half of your retiree population.
Okay. Thank you very much. Thank you, Mr. Chairman.
Commissioner Van Sickle.
Thank you, Chair. Good afternoon.
Good afternoon.
You quoted we're at 69% funding
Yes.
now, and that the original projection estimated we'd be at 52% now.
Correct.
Am I understanding? Is there such a thing as fully funding?
Yes.
And did the original plan estimate when fully funding might be achieved?
Yes. Bear with me a moment. So we expected your obligations to be paid off in the year 2043.
Okay, and with the current level being 69 versus 52, how much would that pull that in?
So when would we expect you to achieve 100% funding?
If you haven't calculated it, that's fine.
Yeah, I haven't. Certainly before 2043. A lot of it depends on, the experience of the plan, which can be difficult to predict. We know nothing good lasts forever, and
Right.
some of the things that could happen would be increased costs because of labor shortages. Hospitals and medical facilities are having trouble attracting and retaining employees, so they have to offer them higher wages, which drives up cost. Price inflation has some impact on healthcare costs. So it's difficult to say with certainty, but you could certainly get there, certainly before 2043, with a continuation of good experience that you've had.
And what will that do to the county budget? We'll lose a piece of funding out as a line item or something?
So right now, the funding source for this program is coming from a fund that holds the bond proceeds. So it doesn't really come out of the county's budget. Once you hit 100% funding, it will depend upon how much money you have left in the bond trust. You'll still have ongoing payments once you hit 100% funding. So what that number means is that the obligations for people that are currently employed, the obligations that they've earned to date, and 100% of the obligations for your retiree population, those are fully covered. And that's with the caveat that the fund continues to earn 7% investment return per year. But for the folks that are currently employed by the county and covered by this plan, there's still an ongoing contribution to cover benefits that they're earning prospectively. Mm-hmm. But, assuming that you have sufficient funds in the bond trust to cover the cost, you may not see any impact on the county's budget.
Okay, thank you. I don't want to take the time here, but I got to talk to somebody offline about how the bond trust works. Probably give Mr. Steve a call. Thank you.
Bond trust hasn't even broken our principal yet. We've earned so much money off that bond trust that we haven't hit principal, and that's really remarkable.
Excellent news.
Well, Commissioner Van Sickle, you yield the floor.
Yes, thank you.
So, I know Chair Brown, you're back up here. Just really quick before we get into the second round. So, Steve, I know you put together a presentation for us. I think that question actually is slide 5 in your presentation. If you
I got a slide over there.
so,
but I can talk to it.
but if you'd like, Steve, if you just like, we don't need to go through. I see everyone probably has looked at probably page 2, 3, and 4. If we can go to 5 and 6, if you can just give us an update. If there's any other, Louise, you're still obviously, if there's any other questions that come about, but I know Steve put together a presentation specifically in regards to Commissioner Van Sickle's question. So, Steve, you want to talk a little bit about that?
So as Louise indicated, Commissioner Van Sickle and other commissioners, so we have bond proceeds that we put into a trust fund. We call it the Intermediate Trust Fund for short. Those funds are invested very similar manner, almost identically as the pension fund assets. There's another trust fund called the Retiree Health Care Trust Fund, which is the fund that actually pays the premiums and operating costs of the program. Those assets are also invested almost identically as the pension assets. So every year, there is an amount transferred from the intermediate trust to the retiree health care year. So that's how those monies move. Each fund, again, is invested almost identically in terms of asset allocations. They're both managed by 5-member boards that are a little bit different in composition. But that's mechanically. I don't know if that answers your question exactly.
Thank you, more or less. Let me take it offline and think about it and study it for
Okay.
a little bit and get back to you.
And back to your question of how this affects the budget is, what we budget is for the debt service payment. So prior to issuing the bonds, well, let me back up. Let me go back 30 years. So this whole thing started 30 years ago. And the county had its first actuarial evaluation back in 1993. And as you'll see on page 6, we were $108 million in the hole at that point in time. So fast forward to 1997, the real estate market starts to take off in the north end of the county. My mentor, Dave Deagle, who was the finance director for many, many years here, had the foresight to start setting surplus monies aside in the Retiree Health Care Fund. So between 1997 and 2004, we set aside about $65 million of pre-funding. So that's sort of how this all started. But you'll see on page 6 that even though we were pre-funding, we were still falling behind. So you can see that the $108 million, grew to $643 million, 13 years later in 2006. More and more people were retiring. In 2004, we stopped setting aside dollars for pre-funding because of other budgetary pressures. So we went back to pay-as-you-go. And we were as pay-as-you-go until we issued the bonds in 2015, and now we contribute 100% of what the actuaries tell us we should set aside each and every year. So we budget the debt service, assuming, again, as Louise indicated, there are sufficient assets in both trust funds over the course of a number of years in the future. That debt service is a fixed cost to us budgetarily through 2035. That's when the bonds are paid off. You'll see on page 6 as well the funding percentages as they progress through the years, and you'll notice in 2013 the funding percentage went from 19.2% to 37%. That's the first valuation that took into account the new structure. We closed the pension fund and the retiree health care fund to put a stop, kind of to the accrual of new benefits to new employees. And then as you go down, of course, we see the 61.7% at the end of 2019. Again, mentioning if we look at the two funds combined, that's the green line at the bottom. We have about, at the end of 19, there was about $289 million in the intermediate trust, in addition to the $302 million that was in the retiree healthcare trust at the time. So if you combine the two, you could make an argument that overall we're over 100% funded for this program. The reason we have assets in the intermediate trust is in the event at some point in time, if the retiree healthcare fund becomes 100% funded, we can use the monies in the intermediate trust to pay pension contributions, defined 401 contributions. We can call the bonds and take the money out of the intermediate trust to pay the bonds off if we're at a financial point where we can afford to do that, or if it makes sense. So, probably a lot of information. I hope
Yes,
I'm not
it is.
confusing it too much.
Thank you.
So,
And then Steve, really quick too, because I think what's really interesting is also on page 7 where we show, what the required contribution was back in '93 to what we were truly contributing compared to 2019.
correct. And you can see even though we were making some excess contributions, we were contributing a high of 79% in 2000 or 1999, but it dropped back down into the 20s. Investment performance is contributing to the lowering of that amount, as well as favorable claims experience. But you can see in 2021 we contributed $20 million. That was the required contribution. The debt service is about $18 million a year on that. So we're paying about $2 million less than we would have if we were trying to fund this program through general fund dollars, if you will. And slide 9 will give you a better perspective of what the debt service is compared to the actual premium costs. And that's ranging call it $1.5 million a year, depending on average. So that's sort of the benefit as it's turned out in terms of how this program has worked. It's worked exceptionally well. It was definitely a hedge play, for sure. It's worked out favorably so far. Louise mentioned previously, we smooth gains and losses over 5 years, so there's some downside protection built into the plan. 2020 and 21 each had returns about 15%. Our assumption is 7%, so it's a nice spread there to smooth over 5 years. So I would expect these funds to continue to perform well going into the future.
Chair Brown, did you have a question? I know you're on the list, but you're no longer there.
No, I'm passed, Mr. Chairman. Thank you.
Commissioner Kleinfeld.
Steve, you said the jump from the 19 to the 37 was when we did the changes. I thought we didn't do the cutoff until 2016.
We did, but Louise and her team took all those changes that were going to happen in 2 or 3 years in the future into account when they did the 2013 valuation to determine how much in bonds we needed to issue.
At the time that we did that, was that already negotiated and settled?
With the bargaining units, with the
Yeah.
employee unions? I can't remember, actually.
Okay, thank
I
you.
can't remember. That was the first valuation, which is why you see such a drop.
It just seemed to me to be odd to do the evaluation in anticipation of something that had not yet been.
I can't remember, Commissioner, but there was no impact on the benefits provided to the employees.
No.
And it wasn't, we
Right.
weren't going to ask them to pay for part of this or anything like that.
Okay, thank you for
So I'm
clarifying.
not sure it needed to be bargained, I don't know that for sure. But what I would also say is that if you look at page 7, between 2015 and 21, there's about $158 million, $160 million of contributions. We put $322 million into the intermediate trust to begin with. We made $160 million of contributions in that 5 or 6 year period of time. There was about $325 million in that fund at the end of 2021.
Oh, the folks in 25 years aren't going to know what to do
Yeah.
with themselves. They're going to have so much money. It kills me.
It's a risk, there's no doubt, there's some risk, but we're benefiting from it today.
Thank you, Chair.
I really don't have any more comments. If you have any questions.
I don't see any other speakers. Luis, thank you for being here today. I think what we'd like to do is have you back once we get the 21 data in, just to kind of see where we're at after.
Yeah, we have a couple valuations to get caught
Exactly.
up on, but
So, seeing no other speakers, please vote.
Motion passes 13-0.
Okay, next item is the federal single audit for December 31st, 2020. I need a motion to receive and file.
So moved, Song.
Support Nard.
Moved by Song, supported by Nard. Steve, you want to tee it up?
I will tee it up very quickly. We have representatives from Plant Moran here today to talk to you about the results of the federal single audit for the year 2020, which, of course, was a big year because of all the CARES money and other federal stimulus dollars that we received throughout the county. So we have a significant increase in the amount of federal awards that we administered that year, and I will invite the Plant Moran folks up to introduce themselves and talk about the results.
Good afternoon, Commissioners. Glad to be here today. My name is Ali Hijazi. I'm a principal with Plant Moran, and with me today is Manju Patnaik. She's a senior manager that oversees our team that conducts the federal single audit. Before we get too far into the presentation, just a few overall comments. As Steve mentioned, 2020 was a year of significant federal funding received and expended by the county. As you'll see when we get further into the presentation, the county's federal expenditures that were subject to audit this year were more than 3 times what it normally spends in a particular calendar year, and most of that from the coronavirus relief funds, which were provided to the county with, at the time, very little guidance on the applicable rules and not a lot of time to plan for and spend the funding. So compliance when spending any federal funding is extremely important, and that means it requires a lot of attention and time and resources from your staff, as well as from ours, given that when the volume is greater and the complexity is greater, obviously the audit is significantly more involved. So we do really appreciate the help we've received from the county staff, both from finance and all the departments impacted in administering the grant and helping us get this audit issued on time. So on the first slide, just a list of the deliverables which make up that 20-page packet. So our audit report is dated February 4th, 2022. Just given the complexity associated with the audit, the the federal government extended the deadline actually from what would have been an audit that was due September 30th of 2021 to March 31st of 2022. So the county's audit was completed and filed on time. I get the pleasure of giving the good news, which is that the opinions that we provide on the single audit are unmodified, what we call unmodified, but essentially clean opinions. That means that the county complied with the requirements of the grants that we've audited. It's the highest level of assurance that we can provide on a single audit. And as Manju will get into, she'll talk about the level of federal expenditures and the couple of findings that we did identify during our audit. But overall, given the volume of dollars and the complexity involved, a very good result. And I'll turn it over to Manju, and if you have any questions, happy to entertain those. Manju?
Thanks, Ali. Good afternoon. I think we've heard this a few times, right? 2020 was a different year. The county typically spends anywhere between $55 million and $65 million each year. In fact, in 2019, the county expended about $67 million of federal expenditures. And then here comes 2020, the county expended $218 million of federal expenditures. That's a big number. That's a lot of federal dollars that the county had to administer. And interestingly, typically we test about 4 or 5 programs based on the directive that's provided to us by the Office of Management and Budget at the federal level. But because of the way the dollars played out and because of how the rules apply, we actually had to test 2 major programs. The one is the Coronavirus Relief Fund. Obviously, you spent about $145 million of that funding. And then the other one is the Temporary Assistance for Needy Families, which is about $4.7 million. But when you think about the Coronavirus Relief Fund, that's equal to like 4 or 5 different programs because of the volume of the dollars and the kind of programs that the county supported with that funding. The end of an audit, we typically report on whether there are any findings or there aren't. So as a result of this audit, we identified 2 findings that we're reporting both to you as the governance as well as to the funding agencies and the federal government. One thing I'd like to comment upon is both findings did not result in question costs. So question costs would be costs that we would consider as costs that were made towards ineligible or disallowed activities where there could be a potential that the federal government could come back and say, you may need to pay these back to us. So the 2 findings do not identify any such disallowed costs. What the 2 findings really cover is just to relate it to certain internal controls and processes around certain areas. So the first one relates to agreements with subrecipients. So when the county enters into agreements with subrecipients, there is certain language that is required by what we call uniform guidance. And in one agreement, we noticed that such language was missing. And this relates primarily to the Coronavirus Relief Fund. The other finding relates to the completeness and accuracy of the CFA. The CFA is basically those few pages within the 20-page report that Ali pointed out to that includes all your federal expenditures. And that's basically called the CFA. And within it, there was about $1.1 million of expenditures omitted, which then was corrected and filed appropriately. So those were the 2 findings we identified, for which management has provided corrective action with a plan to get those findings resolved. With that, we come to the end of our presentation. Any questions?
That was returned because of noncompliance by the county?
Not that I'm aware of.
No, there were not.
So when you mentioned that there was a the county did not include any, you keep saying the county, was there any specific department that did not fill those requirements? Do you have those departments? Because there are many departments that naturally have the federal funding.
So I can maybe speak to that. And you
Yeah.
want to weigh in? So on the the first finding related to the subrecipient agreements. So they're actually the one agreement that didn't have the required elements. It was previously a county department, so it wasn't kind of treated the same way as the county's agreements with other third parties. So when the county enters into agreements to provide its federal funding to other agreements, it does have the required language. It was just this one agreement with the county department, was Martha T. Berry, which is now a component unit, but had been a department for a long time that didn't have those required elements. But there was no non-compliance or funding that had to be returned as a result of that finding. The second finding was really just $1.1 million of food assistance that was not flagged in the system as being from a federal source. So that just was required to go on the report, so that was added on. And there's been a change now in the county system to flag non-cash assistance as federally funded, so that can be corrected going forward.
You know, with all the requirements that the federal government requires, I can understand why you could miss one or two going along the way for that. So I do understand. Thank you, Chair. That's all I have.
Commissioner Kleinfeld.
Actually, it was going to be, I was going to specifically say, when I read it, I was like, this is Martha T., because we all still view it as county services. It's how we viewed it, as opposed to somebody there or somebody here not doing what they're supposed to do. We view it as a county facility. Thank you.
Ali, so I know with this being a single audit, because of the amount of money, we had to separate this and do a specific audit related to this. So in regards to what the county spends on an annual basis, which is about, what, $67 million, which is encompassed in our normal audit. So that was part of this entire process and the total of $218 million. In regards to the material weaknesses identified, do you, and I know you do a lot of these single audits across the state, do you know of any other form of government that has had that identified as a no? I'm just curious, with all the changes that had happened through this.
Yeah, great question. I would say that every single audit that I've been involved in that has this funding has had a finding.
Yep.
And I would say that on the scale, every finding is, of course, serious, and we want to make sure you address it. But on the scale of the sorts of findings that we're seeing, these are definitely less severe than what we've seen. And a lot of that is driven by the volume and the time that folks had to administer. So I think it's an excellent result. But obviously, any finding needs to be kind of remediated.
Yeah, I would agree. And I know we just spent like $10 million in a new accounting system / HR system. So to have only 2 findings under the old system to go into the new system, I think it's pretty remarkable. Chair Brown.
Thank you, Commissioner Sabatini, Chairman. The CRFs, the subrecipient agreements, explain what those are.
So the county, because of the amount of dollars that the county has to administer, the county gets into agreements with other communities and entities like Martha T. Berry that are considered subrecipients, and they in turn then administer these grants on behalf of the county, basically, or towards projects that the county would like to spend funding towards.
So we gave a lot of money to first responder departments throughout the county.
Yep.
Mm-hmm. So there was no agreement for what that money was to be used for, is what you're telling me?
Yes, because when the funding is provided to a department that's within the county, it's not considered a third party or an outside entity that's performing the work. It's just a county department that's performing the work. But in this instance, the subrecipient was an independent entity outside of the county. Even though it's a component unit of the county, they're considered a legally separate entity.
So were they given a blank check with the money?
No, there was an MOU. There was, go ahead.
Yeah, I'm just curious, Steve.
So as Ali mentioned previously, so this is related to Martha T. Berry. So if you
All of it?
All of it.
Okay.
So we didn't have the language because we didn't have an agreement. We had an informal agreement. We didn't have a written agreement. You may remember I came to you when we were deciding how much to give out to all the local units. I think we came with 26 or 27 subrecipient agreements. We came with a master agreement with a list by community of how much. Martha T. Berry was not on that list
Okay.
because, as Commissioner Kleinfeld mentioned, even in my mind, they're quasi-county, if you will. So they were just excluded.
Okay, all right. Very good. All right, thank you. Thank you, Mr. Chairman.
So just to be clear, Steve, so if we would have had that agreement in place, this wouldn't have been a finding?
That would not have been a finding, correct?
Okay. And the other finding in regards to the food donation specifically, we classified those differently? Basically, they were still accounted for, we just accounted for them differently?
Correct. They were accounted for, they just weren't flagged as being from a federal source.
Okay. Commissioner Farrington?
Thank you, Mr. Chair. I just want to know how excellent this is, and all the more reason for no new internal audit group within Steve's department.
They do such a good job, they don't need to be audited.
It's going to be a tough sell later this year, Commissioner. I see no other speakers. Thank you for being here, Ali, and team. Please vote.
Motion passes 13-0.
Okay, next item is full board approval at the committee due to statutory deadline for the 2022 Macomb County Equalization Report. I need a motion to approve.
Motion by Romano.
Made
Support,
by
Van
Romano,
Sickle.
supported by Haw. Kristen, you have the floor.
Good afternoon. This is my favorite day of the year. I don't know if it's yours. Culmination of a lot of work for my employees and all the local unit assessors, but here we are. And everybody hit their target between 49 and 50, so we do not have to do any factors this year, which is a wonderful thing. I was told to keep it short and sweet, and so I'm going to do that. I just want to point you to I think page 5 of my report, and I don't know how the numbering is working for you guys. It's an SEV versus taxable value line graph. I think that's probably the most interesting thing about this report. Other than that, it's a bunch of numbers. But this really gives you an idea of where we were, where we went, and now where we are today. We're at $42.9 billion, which is great in our assessment and SEVs, and we're at 32.8, and this is the first year since the crash that we've actually gotten back to where we were. However, I was quickly reminded by the wonderful people in finance that it's not really relevant because that value is very different today than where it was, what it meant back then when we first crashed. Right, Steve? So if you want anything further about the value of a dollar today versus the value of a dollar then, it's them to answer those. The other interesting thing that I always like to point out, the in-between pages, it's just a bunch of reports, tabular reports that I'm supposed to do on your behalf, according to 21134. And so that's what all that is. But the other interesting thing on here is the average residential true cash value, because we, even though we're in the middle of a pandemic still, the values are just ridiculous right now. I don't know if anybody has recently tried to purchase or knows somebody that has tried to get a property, but you can't. And so on page 44, the average residential property in the county is at $230,000. So, that's market, and I'm chasing market. I'm always 2 years behind on the market values. And so, I just want to say that I've been here before, back in like 05, 06, 07. So I hope we coast a little bit. I hope we slow down a little bit. I don't like to see the CPI as high as it is. It's only going to get higher. And of course, with that, we don't have enough adjustment and loss to offset in our millage reduction fractions. So I've already let these guys know that our rollback is a little bit bigger, a little bit higher than more of an amount than it has been in the past. So, even though we have increased taxable values, we're not going to get that. So, that difference back. But that's really the highlights of this report. If anybody has any questions, I'll be happy to try to answer
So
those.
can you talk about a little bit more about the rollback and where we're going to be at with that?
So last year was 9904. 9904, I think that's what I have in my notes. 9903. And so what that means is, in a perfect world, you just get whatever the millage rate happens to be at that time that we're putting out the levy against the taxable value. But whenever we have a rollback, we take wherever the millage rate is at that time and we have to roll it back. So it reduces the millage rate. So the taxable value has increased, but the amount of millage rate has to be rolled back. And that goes way back to Headley Amendment, way back before we had taxable value. Is it an antiquated thing at this point? Possibly. There are people investigating that. But we have it, and so that's what we have to deal with. And so this year it's calculated at 0.9881, which means, again, we have a 6% increase in our taxable value from last year, but we have to roll it back even more than we did last year. So, it's going to offset any additional taxes that we might have been thrilled to see because of that increase in the taxable value.
And then in regards to the municipalities, I'm looking at Macomb Township. Obviously, that's who I represent. And just obviously, we have a lot of residential doors there. So, I mean, it's probably the best indication relative to the residential piece in this. So their increase year over year was almost 15%.
What page are you looking at? I'm sorry.
I'm looking at page 37. So the real residential CEV.
The real residential CEV.
I'm sorry. Yes, but I think my percentage is.
Okay, so the percentage
of the
over
county.
there is actually the percentage of the whole county.
Yeah, I just noticed that.
Yeah. That's not an actual end over end.
Is there a slide?
I have an overall market increase, and that's at the end of all of the, it's on page 40. The overall increase from market is 5.2.
Okay.
And we're still not done. Again, we're lagging, so.
And that's across the entire county?
Yeah, 5.2.
Okay. Commissioner Kleinfeld.
Thank you, Chair. So you're 2 years behind. Are you 2 years behind on the inflation rate as well?
No, the inflation, well, okay, so I guess it's the inflation rate, it's calculated over a 2-year period. So, I mean, if you want to look at it that way, yeah.
Right.
The first half of the calculation was much lower. The second half has been on the higher end. So now next year, we'll have the higher end.
Right. Next year, we wouldn't expect the rollback to be as extensive.
We'll see.
And you speak in government language, and I know that Commissioner Sabatini knew exactly what you were saying, but it's really, really, really important that everybody understands one basic thing, and that is we can never grow by more than 5% or the rate of inflation, whichever is less.
That's correct.
So when the property values double, doesn't matter, we can only go by 5% or the rate of inflation, whichever is less. That's what causes us to roll back the tax rate. If we were growing too fast, we have to, by law, roll back the tax rate to make sure we don't collect that much money. I share your concern because we do all this rollback, and then if property values drop, they don't have an opposite. They don't have an opposite mechanism to allow us to make up the money that's lost.
Right.
And it could be catastrophic if it happened again.
Well, and that's kind of shown in that graph. It has taken 14 years to get back to where we were when we maxed before the crash.
And I know, I think that there's a very high percentage of elected officials statewide that don't understand how Proposal A in Headley
Well, nobody, I mean, at that point, there really wasn't nobody thought that there was no history of the values dropping like this.
Right.
And then try to explain, for those of you that lived through that, me standing at the counter trying to explain, yes, your taxes are increasing. Yes, your value is dropping. That doesn't make sense. It's a very, very difficult thing. And so it was never put in there. But again, there are some people in my circle of people trying to get rid of the millage reduction fraction aspect and the rolling back, because Headley was put into play before we had taxable value. In the past, values could jump 5%, 10%, 20%, and that's what you paid taxes on.
And I thought it was a court ruling that judged that's how they play off of each other. Maybe it's not. Maybe that's just the way the state looks at it. But if what happened in 2008 happens again, it's our own fault, because we've got, in my opinion, the faultiest tax structure in the United States, and we're doing nothing to fix it. And it will happen again, whether it happens off of this increase or off of another one. It's going to happen again. And if it happens too quickly after the last one, there will be a whole lot of local units of government that won't survive it.
I would also like to point out to all of you that this is the last year, as long as they file, that we will be seeing any industrial personal property on the roll. This is the last year. So 23, everything falls off. So they have to file a form, and they pay a fee. They pay a different kind of tax. They just don't do it through a property tax. So those values will come off as long as they file their exemption form. So that's
all right. I just use a different language than you do. I know what you're saying, but when you're if you're talking to a resident or something, they just stare at you, have no idea what you're saying.
So back in 2014, the voters in Michigan voted to get rid of, or to enact a exemption for eligible manufacturing personal property. So everything that has to do with an industrial business, whether it be the presses, the press pits, the machinery, the office equipment, all of those different things, if it's in an industrial business, they can file for a eligible manufacturing personal property exemption. They spread it out for a period from 14 to 22. So for that many years, in the way, to make it a long story short, I guess, personal property, every year, it falls down to the next line item, and then it's valued a little bit differently with a modifier. It's not necessarily, it's just a valuation modifier. It's not necessarily a depreciation. Depreciation is part of it. But anyway, each year, that same piece of equipment would go down to the next year and be worth less, and it'd go down the next year and be worth less. So what we did was we took off the bottom part and the top part, and then we left these 8 years in the middle to process through and phase out of personal property for the eligible manufacturing. And it was an idea, a way to bring businesses back to Michigan. Everybody was leaving, and so it was an idea, hey, bring the big businesses back. They don't have to pay property taxes on the businesses. And we're one of the few states that actually still has that. So don't be surprised if they figure out some other way to get rid of that stuff. So now we're at the end of that 8-year phase. All of it has dropped off the top, all of it has dropped off the bottom, and we have this last year, this year. So on next year's, expect that industrial personal property line in all of these reports to be very small. I mean, there's going to be a couple of business. We have one that just refuses to file it. They want to pay property taxes. Okay, well, we can't make them file the exemption form, but the majority of them will fall off. So.
Thank you, Chair.
Kristen, I know we're approving this today because of the statutory deadline. What is the deadline?
So so I have to turn in, there's a bunch of other things that are included in this report, but the 4024, which one of you, I think Commissioner Brown will be signing, that's the official statement of the assessed values for real and personal and the county equalized values. So that is due on the 18th of the month. But in order for me to get all of that stuff put together, This is the statutory meeting deadline for equalization. If there was any issues, if you guys saw an error or something in the process, then we would have to come back and fix that by that deadline so that I could file the report.
Okay. One last question here. In regards to that graph, because that's the first thing I looked at too when I was reviewing this. Have we ever had a difference this large? That's like 10 billion, right? That difference between in 2022 relative to the taxable and the equalized value. Has it ever been that large?
So I would have to go back all the way to 1995 was the first year that we started having, the difference in the two values. It was past in 94, 95, I think they were the same, and then it started to spread. I don't think so. I think it was, they started out together.
Because in 05, it's, what about 7, 6, something like that. So,
Yeah.
I mean, that looks like that's the closest on the graph.
Yeah, this is, and when you start throwing in, I've never seen a CPI, what we're capping the taxable value increase at. It's never been at 5. It's been at 4.7, I think. But then the year after, it was under. It was 0.96. So instead of an increase in the taxable value, the immediately following year, it was under. So we had to reduce across the board every taxable value. So that's why I get we're approaching that again, and I like, we talked about it, 2%, just 2% each year, just keep it at 2. That's a nice steady increase. So when we start getting a little bit bigger, the assessor and me starts to worry about maybe some inflated values. The market is so volatile right now that, that's kind of what happened before. At least we don't have the mortgage fraud and all that kind of stuff happening at the same time. We don't have a lot of businesses leaving the area. So there are a lot of other things in that perfect storm that aren't a part of this right now. But a CPI this high, that's a lot,
I think what's different though too is the inflation number compared
everything.
to what it was
Yeah.
years ago. Chair Brown.
Thank you. Are there any communities that had difficulties making the reports? I mean, in past years, we had certain assessing departments that were dysfunctional and had errors, and they had trouble getting, and oftentimes our staff was subbed out to them.
The only department that has been subpar for the reporting is Lansing. So I hate to say that this year. They have created a new program. Nothing has worked so far. It's fix it on the fly. And I have a fix for reports and things that are due on Monday that I have to statutorily file by Monday, that their system will not be fixed until Thursday night. And of course, we have a holiday on Friday, and then it's Monday. So, yes. So that's why I'm hoping that you guys will approve this today so that I can move forward, but we can always talk about it, again in a week or two if you'd like.
When was the last time there's been discussion with the local municipalities about the county doing their assessing for them?
Please, I am not in favor of that. I don't have the staff. We are not Oakland County. Oakland County has 100 people. I have 10. It's me and 9 others, and so we're spread kind of thin already. I would have to employ all of them to do it, so it's better. They know their stuff better than we do.
Not always. My experience. All right, thank you very much. Thank you, Mr. Chairman.
Okay, seeing no other speakers, please vote.
Motion passes 13-0.
Thank you, Kristen. Okay, next item is 7A. This is a contract with Otis Elevator Company for elevator maintenance in the amount of $122,667.60. Need a motion to recommend this to full board.
So moved by Romano.
Made by Romano, supported by Wallace. Larry, you have the floor.
Good afternoon, Commissioners. I know this is a big change from what was just presented to now going on to some maintenance contracts. So we'll start with the first one. It is Otis Elevator. Otis Elevator has actually maintained the General County's elevators for probably almost 40 years or longer. I want to say that because the last contract was a 20-year contract. The reason we're bringing it to the board on this is through an actual Omni cooperative, which got us out of the 20-year agreement that Otis requires, and puts it more back into our hands of being able to dictate how long we keep our elevator maintenance agreement. As you see on this, it's actually 2 contracts, one for the Department of Roadside. They had the same issue. They were actually with TKQ, which mandates a minimum of an 8-year contract agreement, to the point, though, that it's so convoluted we had to use our corp counsel to start getting rid of that contract. So again, digress back, on this, as you see that we didn't bid it out, is through the cooperative, and the only reason we're doing it this way now is so we can have more control over it. And then the second part of that is by allowing us to have more control, we actually didn't lose, it didn't cost us any more by not agreeing to a 20-year commitment. Because of the economy of scales through this cooperative, we actually saved a little bit of money. I forgot what page of the contract it was, but the yearly maintenance agreement is capped at 3%, where previously it was capped at 5%. So again, it was a win-win for us by going through a cooperative. So keeping it short, if you have any direct questions on that.
Commissioner Kraft.
Thank you, Mr. Chair. Larry, real quick, so by changing that method, I was going through all the paperwork and I didn't see a vendor disclosure form. There's none for this one. The one for the next one, it exists, but it's not filled out. And then for the third item, it's there and it's filled out. So I guess I'll jump to 1 and 2.
Yeah, so the first one, again, because this happened so quickly, I would also like to note that I put on the civics clerk that they're 1-year agreements, because we were still getting the contracts, but in the contracts, they're actually stated 5, same way with Transparent Energy. I can follow up with the vendor disclosure. And actually, for the second one, I do have Transparent here, and that might have just been an oversight on our end, because we did bid that out, and so I might have uploaded.
It's included. The paperwork is in there. It's just not filled out. So it's probably just.
So yes, before we sign the contracts, which would, as said, after approval and full board, will go May 1st, I'll have the vendor disclosures updated, and I can forward those on.
Thanks, Larry. Thank you, Mr. Chair.
Commissioner Matuzak.
I was going to say the same thing that Commissioner Kraft said. We need to have those
correct
done and filled out and on file. I just want to say I think it's smart that you all did the cooperative thing, reduce the contract length, save some money. We should be thinking about ways we can do this on lots of other things.
Right, and no fault to Otis. Obviously, these are just the elevator business. It's, again, these contracts, the direct contracts, if you didn't hand write a cancellation letter within 8 months of the termination, it just automatically renewed for another 20 years. And that was same way with TKQ. I believe they require a handwritten letter 12 months prior. Otherwise, they automatically renew. And that's, I don't know, again, I can't speak for Santos and the Department of Roads, but that is, I think, where we're at with them. So yeah, it's Detroit Elevator, all of them, it's all the same. So yeah, this is very beneficial for the county.
Thank you, Mr. Chair.
Okay, seeing no speakers, we can vote on this, but we'll need that information by full board.
Point of order, Chair.
Contract.
Are we voting for all three or just the first one?
Just the first one, 7A.
I was confused because we were discussing all 3 of them.
We can, because the second one, sorry to interrupt, it's going to be about the same speech, Dillon Energy, and it said, stop me if you don't want me to continue on until. Dillon Energy did the same thing. As we buy our gas, our layers, to get discounts on them, it was an automatic 6 months renewal of the contract.
I would just ask the original motion maker if they would reconsider.
We can reconsider and put 7A and B together. That's okay?
Yes, it's fine. A and B.
Any questions on B? Commissioner Van Sickle?
Thank you. Is that gas delivered by somebody else's pipes?
Consumer. And actually, I have Transparent that can explain well more on the.
No, that's okay.
Yes,
yes is the answer. Thank you.
Right.
Thank you, Chair.
Okay, so we have a motion on the floor for both 7A and B to recommend these to full board. in light of the additional documents that are necessary by then. Please vote.
Motion passes 13-0.
Okay, and then the next item is 7C, which is a purchase from SupplyDen for janitorial supplies for $273,000. Need a motion to recommend this to full board?
Motion to recommend Van Sickle.
Support.
Made by Van Sickle, supported by Romano. Larry?
So again, this one, at full disclosure, I just wasn't sure on how to present this one. Obviously, the $272,000 is an average of what we kind of spent. I took 2019, 2020, which was a very high year for our janitorial supply because of COVID and everything. We were just hoarding. And then 2021 actually brought it back down to our normal levels. So we just kind of wanted to present this to say that we've updated our bid for our janitorial supplies, and that we're recommending SupplyDen be our bulk supplier of all our janitorial supplies. They weren't the lowest bidder. As you see, the bid is very, very convoluted. We had every mom and pop company trying to say, yep, we can supply a couple of these items. And when it came down, once we broke all the numbers down, SupplyDen was just about 2% higher. But because, again, we've had a long relationship with them, their customer service has always been on point. Even throughout the pandemic, they gave us a priority over HP product, which is would be considered their main counterpart or competition. And as I said, SupplyDen is just hand over hand has provided excellent customer service for us throughout the county.
Larry, do we have some type of inventory tracking on any of this stuff?
Yeah, through central receiving, we monitor all of it. So I said I can get you the reports on, down to what departments we're using from F&O. Everything is tracked through our central stores.
Okay, seeing no speakers, please vote.
Motion passes 13-0.
Thank you, Larry.
All right, I will follow up with those two vendor disclosures.
Thank you, Larry.
All right, next item is public participation. This is the opportunity for the public to speak for a maximum of 3 minutes on any issue. Seeing the crowd leave, we'll close public participation, move on to commissioner comments. Commissioner Zinner.
Thank you, Chair. I gave a tribute today to a teacher in St. Clair Shores at St. Germain Catholic School. She received from the Catholic Foundation of Michigan the Catholic Education Award, the Amazing Catholic Educator Award. Her name is Chelsea Mulrenin. And reading through everything, she just is an exceptional person, real sweet, very nice. And there were, I believe, 6 other people in the state that received a mention, but she was above and beyond, as they wrote. And she said she couldn't have, she didn't know she was going to receive this, of course, and she could not have received this if it wouldn't have been for her principal and the other teachers. They just wanted to do the best they could for the children. Thank you very much, Chair.
Thank you, Commissioner. Seeing no other commissioner comments, take a motion. Made by Romano. Supported by Wallace. Please vote. Have a great rest of the day, Commissioners.
Motion passes 13-0.